in Brazil right now, we are going through a tenuous political moment with a pension reform, where like our social security system is not sustainable in the long term, and it's perhaps causing outflows from foreign investors, or maybe repelling from money coming in. Do you think it's a true statement?
Let's go all the way back to 2013. Every year, you have a different reason for me to hold back from investing in Brazil, right? In 2014, 2015, the car wash, then the 2006, then another election. Let's wait for the election. You know what? You can't wait. Brazil is an emerging market. And it's a democracy, which also means that you don't get predictability. You're going to get, so if this passes, you think there won't be something else next year that comes up. For people who want to wait for complete stability in Brazil, you're going to be waiting a really long time. I mean, I invest in India too. India has its issues now. It's got political issues. It's got economic issues. Now, you're right, Brazil does have a long-term social security problem, and it's been 30 years in the making, right? Because government after government has allowed this to continue because there are a lot of voters who get that social security, and if you cut it, you're going to lose a lot of votes. So this is not a problem that started last year. It's a problem that's been decades in the process of building. And it's always going to be painful. It's like ripping off a scab, right? You can rip it, or a Band-Aid. You can rip it off slowly, you can rip it off fast. My only advice is do whatever you're doing, do it fast. Get it over with. I mean, it's just, the longer you let this continue, the less good comes out of it. So, but to me, it's not going to stop me from investing in Brazil, because the reality is when this passes, there'll be something else, and then something else, and the next election is going to be here, and then something else, and then something else. This is emerging market for you.
One more question, if we still have time.
Yeah.
We've been seeing a global trend of falling interest rates, sometimes negative interest rates. Even in Brazil, we have this trend right now. It's expected to reach the zero, close to zero in the next year. What investors could expect about the influence of those falling interest rates around the world, or even Brazilian market?
Let it go. I mean, it's not
affecting the equities on the equity market.
As investors, I take the karmic view on these things. There are things I control and things I don't. Interest rates is one of those things. I've got to live in the world I'm in. And you know what? These aren't interest rates that started falling last year. They've been low for 11 years. So when people say this, they're going to bounce back to what? So when I value companies, I take interest rates as what they are. I was in Europe last month, and I valued Heineken in euros. My risk-free rate was negative. Doesn't bother me in the least. Negative risk-free rates are also signals that other things are happening, right? You have deflation, you have low growth. So the same things that keep your interest rates low are also keeping growth low. They're keeping risk premiums high. There's a whole host of things that go with low risk-free rates. So when people say, well, when risk-free rates go up, when stock prices drop, depends, right? Because risk-free rates go up for the right reasons. People start to get more optimistic about the economy. Well, guess what? Growth goes up, your cash flows grow up. So it's very difficult to hold everything else constant and just focus on on interest rates. So I tell people, look, interest rates are what they are. You don't control them. Don't spend your days worrying about what interest rates will do. Just value the company in front of you. Decide whether to buy or sell the company, and then move on. Because otherwise, you're going to drive yourself crazy.
If we look to the equity premium risk nowadays, stocks are not overvalued. They are like compared to the relative T-bonds.
But always add the conditional statement. Given the cash flows that they're creating right now, they don't look overvalued. So when people say there's a bubble, they've got to make a stronger case. And the only way you can make a case that stocks are in a bubble is you got to show me a scenario where earnings collapse, which could happen, and then companies pull back on cash flows, which in the US is stopping buybacks. And if that happens, stocks would very quickly go from being okay to being overvalued. But people who make arguments for bubbles need to do their homework. They can't be lazy and tell me, oh, there's a bubble because stocks have been going up for a long time, which seems to be the essence of some argument. Or the PE ratio is high. So what? The interest rates are low. So you can't just make that argument. You've got to make a stronger argument about economic growth collapsing. And right now people say, oh, global growth is getting lower. Okay, now you got to make the link. If that happens, show me that earnings will drop. And if earnings drop, show me that cash flows will drop. And if you can make all those links, then we can talk about stocks being overvalued.
Yeah, good, because it's a misconception in Brazil. They just look at like the S&P 500 more than tripling in the last 10 years.
Earnings and cash flows have also tripled.
Exactly. The fundamentals,
Right?
like,
So,
they were up too. So.
It's a relative statement, right? So that's why you can't just look at the graph of stock price. They look, they're up 300%, therefore stocks must be overpriced. Well, not necessarily. If earnings went up 300% and cash flows went up 300%, everything's scared up. How can they be overpriced?
Yeah, and if you get like the earnings yield, like the inverse of PE, and compared to exactly.
Yeah. So, I mean, I think people make lazy arguments, and some of these people have Nobel Prizes. So just because somebody has a Nobel Prize doesn't mean that they can't be lazy.
Also, in Brazil, we have a history of high interest rates. So we have a lot of the population that are used to just live through fixed income. And now with this,
you know what? Inflation is deadly for equity. If inflation in the US went to double digits, equities would die. It's just the nature of the game, right? Because when you have high inflation, what's your first priority as an investor? What do you have to do? You have to protect yourself against inflation, right? Everything else becomes secondary, because if you have 30% inflation, you don't protect yourself, you can get ruined in no time at all. So as inflation rises, you are going to get people going to fixed deposits, money that's guaranteed. So it's not their fault. I don't blame them. That's exactly what I would do too. With 50% inflation, I'm not investing in equities.
But do you think like this tendency of low interest rates that it may propel people to invest more in equities?
No, it's inflation. The interest rates are, don't let it distract you. It's inflation worries that will always drive investors. If interest rates are low, but they're somehow kept, they're much lower than inflation, you've still lost the game, right?
That's true.
Because they will then go to other assets that will protect them against inflation. It might be real estate, it might be gold in India. That's a standard fallback. So I think you can't artificially force people into investing in equities by keeping interest rates low. You have to kind of bring inflation under control. So what I would hope is happening in Brazil that's bringing interest rates low is that the forces that drive inflation are being brought under. I'm not sure that's happening, but if that's not happening, then you could have the worst of both worlds, right? You could have inflation still driving decisions and low interest rates, meaning people are not saving money in banks or in financial assets, they're putting it into real assets.